Imagine you're sitting with a close friend, maybe over coffee or during a walk when the topic of retirement comes up. You're talking about IRAs, taxes, and how confusing the whole system can be. Look, I already have a 401k. I was thinking of opening a Roth IRA, but now I'm hearing about this whole Roth conversion thing. What even is that? And why not just open a Roth IRA from the start and avoid all the drama? That's a fair question. Let's unpack it together. And I promise by the end, not only will you understand what a Roth IRA conversion is, but you'll know exactly how to do one if it makes sense for you, whether you're using Vanguard or Fidelity. So first things first, what is a Roth IRA conversion? A Roth IRA conversion is when you take money from a traditional IRA, which is usually tax deferred, and move it into a Roth IRA, which is funded with after-tax dollars and gross tax-free. But the twist is, you pay taxes on that money when you convert it, since the original traditional IRA contributions were often pre-tax. Now you might wonder, why in the world would anyone want to pay taxes now instead of later? Well, that's where strategy comes in. Paying taxes now, at a potentially lower rate, might be a smarter move than waiting until retirement, when required minimum distributions from traditional IRAs could push you into a higher tax bracket. Roth IRAs don't have required minimum distributions at all, and qualified withdrawals are tax-free. So then comes the obvious question. If Roth IRAs are so great, why not just open one and skip the conversion? Good instinct, but there's a catch. Not everyone can contribute directly to a Roth IRA. If you make too much money, the IRS shuts the front door. In 2025, if you're single and earning over $161,000, or married and earning more than $240,000, you're either partially or completely ineligible to contribute directly to a Roth IRA. That's where a Roth conversion, often called a backdoor Roth, comes in. It's a legal workaround that lets high earners enjoy the benefits of a Roth by funneling money through a traditional IRA first. Here's how it works. You contribute after-tax dollars into a traditional IRA. Because there are no income limits to contribute to a traditional IRA, this step is available to everyone. Then you convert that money into a Roth IRA. And if you didn't take a tax deduction on that traditional IRA contribution, the conversion is mostly or entirely tax-free. Now you might be thinking, okay, this all makes sense, but how do I actually do it? Let's break it down step by step. First with Vanguard, then Fidelity. Say you're using Vanguard, which is one of the most common investment platforms for retirement accounts. Start by making sure you have both a traditional IRA and a Roth IRA set up at Vanguard. If you don't already have these, you can open them online. It's pretty straightforward. You'll answer a few questions, link your bank account, and you're good to go. Once your traditional IRA is open, you'll contribute money to it. $7,000 if you're under 50, or $8,000 if you're 50 or older, based on the 2025 limits. Remember, if your income is too high to deduct this contribution on your taxes, that's fine. You're not doing this for the deduction. Now, here's where some people pause for a couple of days. It's not legally required, but many advisors suggest waiting 24 to 72 hours after making your contribution before converting it, just to avoid the appearance that it was a Roth contribution disguised as something else. It's a best practice buffer, not a rule. Once you're ready, you log into your Vanguard account, head to the My Account section, and choose Convert to Roth IRA. You'll select your traditional IRA as the source and your Roth IRA as the destination. Enter the full amount you contributed, say $7,000, and submit the conversion. Vanguard will generate a 1099-R for you the following January showing the distribution from your traditional IRA. You'll also need to file IRS Form 8606 with your tax return to let the IRS know this was a non-deductible contribution and conversion, and that's it. Now let's look at Fidelity, which is just as popular and slightly more user-friendly in some ways. Just like with Vanguard, your first step is to make sure you've opened both a traditional IRA and a Roth IRA at Fidelity. Once those are open and linked to your bank account, you contribute your $7,000 or $8,000 to the traditional IRA. Again, if you're a high earner, that contribution will likely be non-deductible, but that's okay. After a short wait, again, just to play it safe, log into your Fidelity dashboard. Go to Accounts and Trade, then select Transfers. From there, you'll choose Transfer between Fidelity accounts. Your From account is your traditional IRA, and your To account is your Roth IRA. When you get to the next screen, Fidelity will ask how much you want to convert and whether you want to move the funds as cash or in kind, meaning the investments stay the same. Most people convert as cash to keep it simple. especially if the money was just sitting there uninvested. Review everything and confirm the transfer. Just like with Vanguard, Fidelity will send you a 1099-R early next year, and you'll need to file Form 8606 with your taxes to report the non-deductible contribution and conversion. Now, a word of caution. If you already have other money in a traditional IRA, say, from years of deductible contributions, your conversion could trigger a tax bill due to the IRS's pro-rata rule. This rule requires you to calculate your conversion taxes based on the proportion of pre-tax and after-tax money across all your IRAs. So if you've got a large balance of pre-tax money in a traditional IRA, it's often smarter to roll that into an employer's 401k first, if possible, which can help isolate your after-tax contributions for a cleaner conversion. Why does all this matter? Here's the bigger picture. Roth IRAs give you something incredibly valuable: tax-free growth and withdrawals in retirement. That's a huge deal when you're 65 and pulling out tens of thousands of dollars a year. Plus, there are no RMDs, which means you have total control over how and when to spend your money. So even though it feels like jumping through hoops now, the payoff later can be enormous. A Roth conversion isn't right for everyone, but for people with high incomes who want to diversify their tax situation in retirement, or for those who expect taxes to rise in the future, it's a powerful tool. And it's worth understanding, not just because it saves you money, but because when you know how these rules work, you're not stuck playing defense with your finances. You're playing offense. It might feel like a lot at first: traditional IRAs, Roth IRAs, taxes, conversions. But once you understand the strategy behind it, you start to see the real power. You're not just moving money around, you're planning ahead. You're giving your future self the gift of tax-free income. And the best part is that you don't need to be a millionaire or a Wall Street expert to do this. You just need to know the rules, follow the process, and be intentional. Whether you're using Vanguard, Fidelity, or another platform entirely, the idea is the same: make smart moves today to create a more flexible, tax-efficient future. And if you've got questions about your specific situation or want me to walk through Form 8606 or pro-rata rules in a future video, drop a comment below. I read every one of them. And remember, when it comes to building wealth, it's not about getting rich quick. It's about playing the long game, making informed decisions, and owning your financial future one step at a time. And if you found value from this video, consider hitting the like and subscribe so you can help the channel grow. Thanks for watching, and I'll see you in the next one.